Welcome to Trading 101, Understanding the Basics of Stock Market Investing. In this video, I'll demystify the stock market and give you the foundational knowledge to start your investing journey. Let's kick things off by understanding what the stock market is. Imagine the stock market as a vast marketplace where investors buy and sell ownership shares of publicly traded companies. These shares, known as stocks, represent a fraction of a company's value and earnings. Major stock exchanges like the NYSE and Nasdaq facilitate these transactions, ensuring a transparent and regulated environment for trading. So, why invest in stocks? Historically, the stock market has delivered substantial returns over the long term, outpacing other investment avenues like bonds or real estate. Investing in stocks allows you to grow your wealth and achieve financial goals, such as retirement or purchasing a home. Next, let's talk about how the stock market works. Stock prices fluctuate based on supply and demand dynamics. When more investors want to buy a stock than sell it, the price rises. Conversely, if more want to sell, the price falls. Factors influencing these movements include company performance, economic indicators, and market sentiment. There are primarily two types of stocks: common stocks and preferred stocks. Common stocks are the most prevalent, granting shareholders voting rights and potential dividends. Preferred stocks offer fixed dividends and have priority over common stocks in asset distribution, but typically lack voting rights. Ready to start investing? Here are the steps. 1. Educate yourself. Understand fundamental concepts and strategies. 1. Set financial goals. Determine what you aim to achieve through investing. 1. Choose a brokerage account. Select a platform that aligns with your needs and preferences. 1. Develop a diversified portfolio. Spread your investments across various sectors to mitigate risk. 1. Start small. Consider beginning with low-cost index funds or exchange-traded funds, ETFs, to gain exposure to the market. Investing in stocks carries inherent risks, including market volatility and potential loss of capital. However, with thorough research, a long-term perspective, and disciplined strategies, you can position yourself to reap substantial rewards. Several investing strategies cater to different investor preferences: value investing, growth investing, and dividend investing. Value investing seeks undervalued stocks with strong fundamentals. Growth investing focuses on companies with high growth potential. Dividend investing prioritizes stocks that provide regular dividend payouts. Diversification involves spreading your investments across various assets to reduce risk. By not putting all your eggs in one basket, you protect your portfolio from significant losses due to any single underperforming investment. Long-term investing focuses on holding investments for extended periods, capitalizing on compound growth. Short-term investing or trading seeks to profit from market fluctuations but requires more time, expertise, and entails higher risk. The journey to financial empowerment through stock market investing begins with a single step. Equip yourself with knowledge, remain patient, and stay committed to your financial goals. Thank you for joining me on this introductory exploration of stock market investing. Subscribe to the channel for more insights and strategies to enhance your financial journey. In this chapter, we'll delve deeper into the history of the stock market, exploring its origins and evolution over time. Understanding the stock market's past can provide valuable insights into its present behavior and future trends. The concept of stock trading dates back to the 17th century, with the establishment of the Amsterdam Stock Exchange in 1602. It was here that the Dutch East India Company became the first publicly traded company, issuing shares to the public. This innovation laid the groundwork for modern stock exchanges and investment practices. Fast forward to the 19th century, the New York Stock Exchange, NYSE, was founded in 1792, becoming a cornerstone of the American financial system. Over the years, the NYSE has grown to become one of the largest and most influential stock exchanges in the world. Let's explore some of the most significant events that have shaped the stock market. The Great Depression of the 1930s stands as a stark reminder of market volatility and economic fragility. Triggered by the stock market crash of 1929, this period saw massive unemployment and economic downturn, leading to major reforms in financial regulation. Another pivotal moment was the dot-com bubble of the late 1990s and early 2000s. Fueled by speculative investments in internet-based companies, the bubble burst in 2000, causing significant market losses and highlighting the risks of overvaluation. The 2008 financial crisis is another crucial chapter in stock market history. Initiated by the collapse of the housing market and the failure of major financial institutions, this crisis led to a global economic downturn and prompted widespread regulatory changes to safeguard against future collapses. Understanding these historical events can provide valuable insights into market behavior and help you make more informed investment decisions. The stock market, while offering substantial rewards, also carries inherent risks. By learning from the past, you can better navigate the complexities of investing and build a more resilient financial future. Thank you for joining me on this historical exploration of the stock market. Stay tuned for more insights and strategies to enhance your financial journey. Welcome back. Now that we've covered the basics and historical context of the stock market, it's time to dive into some advanced investment strategies. In this chapter, we'll explore the intricacies of technical analysis, fundamental analysis, and the use of financial ratios to evaluate stocks. Technical analysis involves studying past market data, primarily price and volume, to forecast future price movements. By analyzing charts and patterns, traders can identify potential buying and selling opportunities. Key tools include moving averages, trend lines, and various indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD. On the other hand, fundamental analysis focuses on evaluating a company's financial health and growth potential. This involves examining financial statements, such as the balance sheet, income statement, and cash flow statement. Key metrics include earnings per share, EPS, price to earnings, PE ratio, and return on equity, ROE. By understanding a company's fundamentals, investors can make more informed decisions about its long-term prospects. Financial ratios are essential tools in both technical and fundamental analysis. Ratios like the debt-to-equity ratio, current ratio, and dividend yield provide insights into a company's financial stability and operational efficiency. These ratios help investors compare companies within the same industry and identify potential investment opportunities. Staying updated with market news and trends is crucial for making informed investment decisions. Economic indicators, corporate earnings reports, and geopolitical events can all influence market dynamics. By keeping an eye on these factors, you can better anticipate market movements and adjust your investment strategy accordingly. Remember, successful investing requires a combination of knowledge, patience, and discipline. By mastering these advanced strategies and staying informed about market developments, you can enhance your financial journey and achieve your investment goals. Thank you for joining me in this chapter on advanced investment strategies. Stay tuned for more insights and tips to navigate the stock market with confidence. Welcome back. In this chapter, we'll discuss the psychological aspects of investing. While knowledge and strategies are crucial, understanding the human mind can be just as important in achieving investment success. First, let's talk about overconfidence. Many investors believe they have superior knowledge or skills, leading them to take excessive risks. This can result in significant losses when markets don't behave as expected. Recognizing this bias can help you remain humble and cautious, ensuring that you base your decisions on solid research rather than overestimating your abilities. Next, we have herd behavior. This occurs when investors follow the crowd, buying or selling stocks based on what others are doing rather than their own analysis. This can lead to market bubbles or crashes. By maintaining a disciplined approach and relying on your own research, you can avoid the pitfalls of herd mentality and make more informed decisions. Another common bias is loss aversion. This is the tendency to fear losses more than we value gains, which can lead to irrational decision-making. For example, an investor might hold on to a losing stock in the hope of breaking even, rather than cutting their losses and moving on. By acknowledging this bias, you can develop strategies to manage risk more effectively and make decisions based on logic rather than emotion. Understanding these cognitive biases is the first step towards mitigating their impact. One effective strategy is to create a well-defined investment plan with clear goals and guidelines. This can help you stay focused and avoid emotional decision-making. Additionally, regularly reviewing and updating your plan can ensure it remains aligned with your long-term objectives. Another helpful approach is to seek advice from trusted financial advisors or mentors. Their objective perspective can provide valuable insights and help you stay grounded during volatile market conditions. In conclusion, mastering the psychology of investing is essential for long-term success. By recognizing and addressing common cognitive biases, you can make more rational investment choices and navigate the stock market with greater confidence. Stay tuned for more insights and tips to enhance your financial journey. Thank you for joining me in this chapter on the psychological aspects of investing. Together, we can conquer the mental challenges and achieve our investment goals. Welcome back. In this final chapter, we'll provide some practical tips for managing your investment portfolio. Having a solid strategy is just the beginning. Effective portfolio management is crucial for long-term success. First, let's discuss the importance of regular portfolio reviews. Markets are constantly changing, and your investments should adapt accordingly. By conducting regular reviews, you can assess the performance of your investments and make necessary adjustments. This ensures that your portfolio remains aligned with your financial goals and risk tolerance. Next, let's talk about rebalancing. Over time, some investments may perform better than others, causing your portfolio to become unbalanced. Rebalancing involves adjusting your asset allocation to maintain your desired level of risk. This can help you stay on track and minimize potential losses. Setting realistic expectations is another key aspect of portfolio management. It's important to remember that investing is a long-term endeavor, and short-term market fluctuations are normal. By setting achievable goals and maintaining a disciplined approach, you can avoid making impulsive decisions based on temporary market conditions. The role of financial advisors is also worth mentioning. A trusted advisor can provide valuable insights and help you navigate complex financial markets. When choosing a financial advisor, look for someone who aligns with your investment goals and risk tolerance. Ask about their experience, credentials, and fee structure to ensure you find the right fit. In conclusion, effective portfolio management is essential for achieving your investment objectives. By conducting regular reviews, rebalancing your investments, setting realistic expectations, and seeking advice from trusted financial advisors, you can navigate the stock market with confidence and success. Thank you for joining me on this journey through the essentials of investing. Remember, knowledge is power, and with the right strategies and mindset, you can achieve your financial goals. Stay informed, stay disciplined, and happy investing. Please like, share, and subscribe to our channel for more insightful content on stock market basics and advanced strategies.